Guys, we got to be real quiet today. The resident bears, Mitch and Dennis, I think they're in hibernation. We don't want to wake them up, so let's be real quiet. Unless we start talking about the spoos being up 68 handles and all the good earnings coming from Goldman Sachs and Johnson and Johnson. Also, I am coming out with my new 2-year target for the S&P 500. Mitch, wake up and roll the intro.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, folks, strong close, gap higher open. You didn't even get a chance to buy that close. We're up 70 and a quarter handles at 37.60. Not any daily highs, folks, until you get up to the 38.20 area, as is illustrated here by this upper right chart. There's 3 highs. Don't know if we can get there today. The buck's not hurting things too much. That's up 22 cents at 112.13. No one really cares about bonds or the TLT. That's down 17 cents, 97.92. Crude helping with the inflationary pressures, down $1.24, 84.22. Gold down $6, not really doing much. Silver flat. Bitcoin, not a risk asset or inflation hedge, up 70 at 19,585. And Ethereum futures, they're just up a couple bucks at 13.25 and a half. Let's bring on Dennis and Mitch, and what are we gonna rip and short and sell today?
This market is completely unpredictable right now. I will say that much. You're trying to call this market day to day. Good luck with it. Huge follow through from yesterday. You know, people are saying, when is the bottom going to be in? I think it was made 3 days ago. I mean, hindsight capital is indeed 2020, but when they bought that CPI data on bad news, that was your sign that this is turning into the silver lining market. We've had a little bit more bad news. They completely ignore the bad news now. FOMO running rampant here. Not chasing, but buying pullbacks. So I think, you know, we've rallied significantly, obviously 2 sessions. We're up another 150 S&P points. So as much as, you know, it's hard to chase that rally from CPI day on Thursday, Friday was the day to buy hindsight capital, again, 2020. I think you'll get more pullbacks. I think you're going to have some earnings warnings, which will give you those pullbacks. I do think some of those pullbacks are to be bought. This is a market where now they're looking at the silver lining again. They're saying, hey, you know, we don't care about inflation right now. Earnings so far have been so good, and everything is priced in. The everything priced in camp is winning right now.
You know, for the first time in a long time, we're having these, you know, big moves overnight to the upside. We were having them to the downside or flat. And remember during like 21, you know, when this market was rallying, it was like, man, oh God, we're coming in 50 handles higher. I can't buy the open. And then it tacks on another 25 or 30.
Yeah.
And then you're there. Friday was the tricky day because, you know, Thursday, you know, you had the big move. And I think a lot of people, you know, piled in on you know, maybe Friday on the open. Then they got tagged a little bit, right? Because they came down. And then the patient buyers, it's that 3,600 level. I know we ticked down to 3,500, but like it just seems like the big money was accumulating in that area. Even if you look at the daily, I mean, all these lows right here, 3,600. Then you had to spike down in the washout, but it really looks like you had some long-term positioning going on there in the long side. And then the other thing that, you know, Cameron pointed out, you know, were people getting out of, you know, this crowded defensive trade, right? The utilities. It was like, okay, you know, we hung around. This was a hell of a run. We got to redeploy, right? And I think that was a sign that the market was willing to take on a little bit of more risk ahead of Q3 earnings season. Now, we haven't heard from the big guns yet, so no. You know, we don't want to get too ahead of ourselves. But Apple, I mean, Microsoft cut jobs today too. Haven't heard from Google, Amazon. I mean, you still haven't heard, like I said, still haven't heard from the big guns. But man, oh man, even if they come in bad, then you have buy the dip mentality might be there.
This is the problem for the Bears is it's turned back to buy the dip again, and they need to break that. So the question is a big gun warn, and then we get hit, and then everybody just comes in and buys the dip? It kind of sets up for that. So I think you're going to have the warning, but right now they're in such a buy the dip frenzy that even if you get a warning, it probably gets bought. I mean, we've seen this market turn into this time and time again where it starts to ignore. But when they turned around about that CPI data Thursday, it was a sign that, hey, maybe the bad news is priced in here. And obviously Friday gave us a huge opportunity, which I did not take advantage of, kind of hitting myself for that because I thought it, but I was like, it was just so ugly on Friday. It was like, man, are they just going to give everything back? And it wasn't the case. It came in Monday, exact opposite. And Tuesday, the follow through, and boom, boom, you're up 150 handles from the low on Friday, and you're like, wow, I missed it. And I think that's the case. I mean, I don't want to chase when we just ride 150 handles. I've been punished chasing in 2022. So, but I mean, chasing yesterday would have worked. Do you chase this rally today? I am not. What are your thoughts?
I feel like at the end of the day, you could have a rally today and you could have a rally in the next couple of days, but I still think that we get back down there. And that's my only concern. And that's the hard part of playing this game. As a day trader, swing trader, I think, yeah, you're playing upside right now. But as an investor, can you really say that the lows are in? That's when I think it gets a little bit troubled, especially when we're hearing mentions like UBS and Barclays yesterday. They put out a number underneath 3,000 on the S&P 500 if we go into recession. You got Jamie Dimon pointing out 3,200. Are all these banks going to be wrong and we're going to be right?
Yes, they are.
Yeah,
that makes you get. That's like some of the bullish. I said this on At the Close show,
right,
man.
Joel.
That's so bullish.
Yep.
It's bullish.
Yep. They're all going to be wrong.
That's how they feel. And I guess all the banks are wrong. We got it right here.
They're always wrong. That's the one thing is, the average analyst is just always wrong. So you listen to those guys and do the opposite. You probably, we should probably talk to our buddy over there, and he should come up with an ETF, just fades every analyst. That would do well too, because they're all wrong. So I think that worries me more, that they're still, they're coming out with bearish targets here. A lot of cash on the sidelines. It's always been the worry for me, staying, with the 42% cash I have right now in the long-term portfolio. The worry for me is that it's all priced in. We've come down a long ways on a lot of stocks. Now, stocks are still not cheap, but with that being said, you've still got this mentality that you haven't completely broken yet. And nobody's got a crystal ball. We may go to 3,000. Maybe these ugly earnings are going to be so ugly that it's not going to be able to, the market's not going to be able to handle it or shrug it off at all. But you just got to trade kind of what's in front of you. And you felt, and you kind of called it, Mitch, the capitulation on Thursday. You kind of felt like a little washout there. And then the rip and turnaround, key reversal in the entire market. And, and then all of a sudden, the bears are caught. And they used Friday, smart ones were trying to get out on the buy the dip, but now they're just chasing. So now, we talked about 380. I do think you're going to have pullbacks along the way. So I don't want to just jump in here and chase stocks. But, as a resident bear for the last year, I've moved market neutral, but I'm starting to move to the bullish camp. So you've got to kind of, just adjust as you go. And the market's telling me that something is different.
What are you to say about recession concerns? Would those play into your factor? Do you think that it already hit and that's why you're kind of more in the bullish?
Yeah.
Some people say that it still hasn't happened, Dennis.
Yeah, they're all stupid. No, we've already had the two, GDP. It hasn't hit hard though. And I still think rates, to your point, Mitch, are going to hit the consumer here. It just doesn't make any sense that, the rates can go up this much and the consumer is just going to find more money anyways. So, I mean, that's the bearish arguments. But the question still is it all priced in? I mean, we have come off, on the Qs. How low did we get here, Joel, off the lows from the highs to the lows? 33%? 470, 480 down to 348. Yeah, it's a serious bear market. 33, 34% off the highs. It's serious. But again, it was irrational exuberance to be up there. You could argue it should never have been there. So I don't know. I'm kind of still market neutral. I want to go bullish. I'm not chasing today. Obviously not chasing. We've just rallied too much too fast. But I kind of want to be a buyer of pullbacks here now.
Yeah, I mean, Dennis, you'd like to call it the recession. We have the definition of what a recession
It hit
is.
the definition.
Right. Yeah, it hit the definition.
But it wasn't bad.
But like,
it hasn't been bad.
I give you the eyeball test, and I don't know what's going on around you, but I mean, I still see it. I mean, and I don't think I live in like some just exclusive area where it's just immune. But I mean, I was in Ann Arbor on Saturday, okay, and there are buildings and structures and just if someone would have said that there's a recession in Ann Arbor, Michigan, I would tell you you're crazy. I go to Kohl's on Sunday to pick up something for Lisa, and the lines are just wrapped around the store. I go into the M Den to get something. I don't know. I don't know if they don't have the money to spend and they're still spending and they're racking up huge credit card debts, but just the eyeball test.
That's the concern. That's the concern for me, and the big concern for me is the worst yet to come. We'll have to wait and see. Let's go to Goldman's numbers here. Goldman Sachs Q3 earnings coming in here at an EPS of $8.25, beating a $7.71 estimate. Sales at $11.98 billion, beating the $11.43 billion estimate. Goldman Sachs' Q3 investment banking revenues at $1.58 billion, down 57% year over year. Global markets revenue at $6.2 billion, up 11% year over year. Asset management revenue was at $1.03 billion, down 20% year over year. Provisional for credit loss at $515 million versus $175 million year over year. And Goldman Sachs says new operating segments will include asset wealth management, global banking and markets, and platform solutions. Also on CNBC's Squawk Box, Goldman CEO David Solomon said that a good chance for a recession, and so it's time to be cautious.
Oh, there's so much commentary there. Again, another investment. The investment banking revenue was not good there, but I guess everything else picked it up. Goldman just finds a way. Goldman
every
always
bank
finds
calling for recession. I mean, it feels like.
It's a very tough market. Let's just go back, and I don't want to call it. There's certain markets that I want to call. That's why I'm like the last week or two. It's been 2 weeks really. I keep saying market neutral. People are making fun of me for it, but I can't call this market. I mean, it's just tough to call day to day. It's tough to call. Is the bottom in? I don't know. If there's a bottom in, it feels like it turned. It might be in, but it might not be. I mean, sometimes you got to just go with the flow, and you just got to trade, and you just got to trade the chop. And that's all you can do right now. I can't come in and give you a crystal ball and say, yeah, the bottom is in, just buy. I mean, there's a lot of bad news still coming. So I'm staying market neutral. I want to go bullish, but I got to stay market neutral here for the simple reason is that this is just not the market to call. On this show, we've been doing it 8 years. We make a lot of calls. Some of them are good, some of them are bad. We called the COVID, sell off. That was an easy one to call. Didn't get the turn, not at all. It turned, and we kept trying to stay bearish and stayed bearish way too long. So we called the recent sell-off in the last 6, 7 weeks. That was an easy one to call too.
It's hard to call.
But you're at a point where it's really hard now because you know what? There's good arguments on both sides. Lots of bad news out there, but stocks have been hammered. So I don't know where the turn is, and I'm not going to try to call it.
We had sell Rosh Hashanah and buy Yom Kippur as an indicator. That was a little bit of a rocky road to maneuver. But we did get Craig Johnson, and I just saw that someone said he revised his year-end target to 3,900, and that is a pretty conservative call, and I think that's a good call. I mean, do we? And I know I keep saying this for months, and it doesn't happen, but there's points where the market just has a direct, it consolidates, right? And we had that consolidation there now near the bottom. Okay. We're going to go up. Maybe it's 300, 3,800, 3,850, or 3,900. You'll get the same kind of formation up there. Everybody will just scratch their head. And maybe, maybe we're going to have a 3,600 to 3,900 trading range. I'm not until we see a tick down in inflation, something like that. And I know I've been saying that for a long time and it hasn't happened, but the markets do lull you into complacency and they do have periods of consolidation. Right now, you know where the support is. It's hard to figure out where the resistance is. I mean, I wouldn't be surprised, look at these three highs at 38.20. There's not much in between here and 38.20. That's not going to be an easy level to get through. It's just not going to blow through that the first time. That's probably a lot of shorter term targets too. I don't think a lot of the money in the market has this like super long time horizon that, yeah, we got to go back to 4,300 for me to make money or 4,400 to make money. These much shorter time frames, 1 week, 2 week, 3 week trades. Boom, I get in, I get a big position, I accumulate over a couple days, I get it. I just don't, us long-term investors, yeah, we stay in the market, but I think a lot of reason you see this chop is this like, these intermediate and big players too, doing these kind of swing trades, and they got 3,800 for a target. They're going to get out. They'll sell there at 3,800 and they don't care. They don't care if it goes to 3,850 or 3,900. We have such a short term,
it's all short term trading, Joel. Your point is absolutely spot on. 90% of it, it's all high frequency trading. It's just the algos are just ripping right now. They'll turn it. They'll turn it in a hurry too, and that's why the chop, is for an investor, it's a nightmare.
Yep.
For a trader, it's got opportunity in it. So it's been a very good trading year. I mean, a lot of people, looking at this year, what a terrible year. I've been posting my results. It's been a very, very good year for trading. You've just got to, but the investing side of it has sucked. I mean, we kept going down. So you keep hoping for the turn just for the long-term investment portfolio here. The turn will happen eventually, but I don't think like it's all of a sudden, we're clear back to, new highs next year. I think it's going to take, years to get back to new highs. And then some of these stocks are never getting back. So, we're just in a new pricing environment, when you have the risk-free rate going up like that. So it's not an easy path, though. But people who just think you short stocks and make money, they're learning the hard way here. That's not the case here either. There has been wicked rallies through this whole thing. This whole sell-off has had lots of wicked rallies. And we're like, and then CNBC, is the bottom in? We're questioning, is the bottom in? I mean, everybody, every time we get a rally, is the bottom in? Was that the bottom? Was that the all-time low? Or the low for 2022? And nobody knows.
Yeah, I can say that we've probably had this conversation about 7 times. So,
at least,
maybe the 8th time will be it, guys.
At least, Mitch. At least.
At least.
And some of these, have been bottoms. They've been short-term bottoms and good trading opportunities. And other times, they've just turned around on a dime.
Yep.
But one thing I've learned, I'll just bring it back to that, in 2022, the one thing that has been consistently wrong is chasing these sudden, these huge rallies, these 5% rallies in 2 days. That has been consistently wrong. Maybe it's going to be different this time, but I'm not going to come in and chase. And we literally are up 5% in 2 days. We're up 5% in 2 days from the low on Friday.
Not done yet.
Well, but I'm saying at this point in time, right now in the pre-market, we are up 5% in 2 days. It's hard to make money chasing these 5% up moves in 2 days. So I'm not necessarily saying I'm shorting it, but I'm saying if I was buying in the last couple of days, I'd be selling into this strength.
All right, let's go to Hasbro here. Let's go to the next stock here. Hasbro. EPS at $1.42, missing the $1.65 estimate. Sales at $1.68 billion, missing the $1.72 billion estimate. Hasbro sees full year 22 revenue flat to slightly down in constant currency. Sees 16% adjusted operating profit margin. CEO Chris Cox pointed to increasing price sensitivity among consumers. And for the fourth quarter, which includes, of course, Christmas, the company expects flat results versus last year's results.
Just take it back to let's just call it, this is not a good quarter for Hasbro. Probably wasn't anticipated to be a good quarter, but we have to respect that, money managers, does this have a silver lining here again? Does it come into the silver lining market? They were like, we got to buy something. Hasbro's sitting down here near the lows. We'll buy this anyways. There's a possibility that could happen. So I don't want to short it in the hole on a day that everybody's looking for something to buy. On a normal day, other things being equal, I would not touch this. I would think in normal markets that we're just, flat, that this would actually get hammered on this report, but it's holding up fairly well, probably just because everybody's looking for something to buy. There's a pullback in Hasbro. Wouldn't surprise me if they buy it. I'm not touching it because it was a terrible quarter, but it wouldn't surprise me if they came in and bought it just because they're looking for something to buy.
Yeah, you did catch that quick dip to 65, and they bought it right back up. I mean, the low of the move was 66, right? 65.84. So I think if you're looking to, you got to do a reset after that kind of number, right? Look for that 65.84. That's a buck and a half away. Two things here. I think you're fine. We'll see if we can get green on the session at 67.71. But I think I think the Bears in this are still in firm control. I'll bring this line down a little bit. I mean, you got a bunch of highs, 69, 69 and a half. So, yeah, it's a nice pop off the bottom, but I think Bears are still full in control. Maybe even say if it can prove it can get above 70. So keeping an eye on the low of the move at 65.84.
Johnson & Johnson's Q3 EPS coming in here at $2.55, beating the $2.52 estimate. Sales at $23.80 billion, beating the $23.47 billion estimate. They lowered 22 guidance. They see full year 22 adjusted EPS at $10.02 to $10.07. Operational sales to $93 billion to a high end of $93.5 billion.
Defensive stock, it's not the kind of stock that they're probably going to buy today, so I don't see this just rip roaring and going. It's always been, trading 16 times earnings. It's fairly cheap, relative to, that's pretty much where it trades. So I'm just me. I don't think this is going to rip to if you're buying some 169, where's it going? 170, 171. It's not, I don't think it's rip roaring up to 175 here. Fine report, but this is not the kind of stock that they're buying if they're going risk on.
Oh boy, it snuck into the 171 handle somehow, some way. It had 4 highs in that area back in August. I don't know if we're going to get back there today. I bet you, all the stock in the book at 67, 68, 69, and 70. You're going to have to find a lot of buyers to even open this thing over 170. So big move in the lower 160s on Thursday, now 171. I'm not buying. I'll see, what the appetite for the bulls are to buy after this big report. Just one thing, I did happen to have CNBC on for a little bit this morning. Turn it on, just and then turn it off when the first commercial comes. But one thing that we might be overlooking, and I heard that the CEO say, maybe if some of these companies that have the international sales, it sounded like they maybe weathered the storm with the dollar. Now, I don't know if Johnson & Johnson has a huge hedging department or whatever. And, I think that's the reason Roblox said, they mentioned the dollar effect. So, I mean, these are big multinational corporations that have been dealing with currency fluctuations forever. I mean, you had a trend in the dollar. Maybe the reason that these earnings are coming in okay is that, maybe they had, they're not going to come out and say it, but maybe they had some hedges on to cushion the blow, because if not, holy mackerel. I mean, it seemed like it would be almost impossible not to have good earnings. So we'll see if someone actually comes out and says that. He kind of said that kind of tongue in cheek. So, big company like that, a lot of foreign currency transactions. Why the heck not, have some kind of hedges?
Lockheed Martin Q3 EPS at $6.71, beating the $6.68 estimate. Sales at $16.6 billion, missing the $16.64 billion estimate. They reaffirmed 22 outlook and also said on October 17th, authorized purchase up to an additional $14 billion of common stock. So upping their repurchase. we'll see what happens here. Lockheed Martin.
Again, this isn't, a market stock. This sometimes actually moves opposite to the market. It's a war stock. So, you always have to keep that in mind too. When you get headlines out of Ukraine, I automatically go to LMT, General Dynamics, NOC, Raytheon, RTX. So sometimes these stocks can actually move opposite to the market. Right now, it's just me. It was down a little bit. They come in, they buy the dip because they're looking for something to buy the dip on. The reports is there. Again, tough. It's going to be a tough day to call. Some days we come in, we make pretty, easy calls. They seem easy. Today is not easy on anything.
You had a nice spike. Let's just see what happens at yesterday's high, 40061. And after that, it opens up to 405. But quick spike over 400 was sold. So I'm looking at that. A real great day. I mean, 407 is your 3-day high. I don't know if it has the momentum to do that. Minor support at the close, 97.31. And if they turn on this stock, yesterday's low was down at 92.15. Just going back like to general market talk here for a second,
Yeah, sure.
and we didn't emphasize it a lot, and I think Mitch and I were kind of on opposite ends of it. But what she said in that speech, like one big thing about the market is everyone's waiting for like the China-Taiwan confrontation in World War III, and we're all going to get blown up. I mean, he didn't exactly said that, and he kind of, I don't know, he kind of talked nice. I mean, I don't know if talk and actions are different things, but if China starts to lift some of these COVID restrictions, to get the economy going again. And there was one thing he said, it's like he said it's our problem, and we will use force, but it didn't. I don't know. I think the market
didn't sound like an imminent invasion was happening.
Exactly.
I agree. And that, I think, calms some fears, too, because that's been a wild card. I mean, the markets would absolutely get hammered if China invaded Taiwan. It would absolutely get hammered.
There's nowhere to go.
So, there's nowhere to go. We're making new lows if that happens.
One thing, though, you said...
That is a calming thing.
One thing you said there, though, Joel, you saying that China is saying something and doing something else. They've never done that.
That's what I said.
I'll give you that too, Mitch.
I just said that. I said
They've never done that before, Mitch.
Yeah, just pointing that out. I mean,
I'm just telling the way the market reacts.
It's difficult here because the truth is, expecting for war. I mean, you're just like, it's like, are we gonna have an earthquake today? It's like that kind of thing. I mean, you're just putting bet on something that could potentially happen, but the truth is we don't know. And with that being said, the one thing that I'm just worried about is positions that are really kind of obtained to either China or Taiwan. So to me, like TSM is off the table for me. I wouldn't be long TSM. No. And even if like on a long-term investment, I would not be long TSM. And just because overnight the risk now is too big for me to be heavily invested into a company like that.
I mean, I'm the same way, Mitch, and that's the one thing is, it's one thing to trade them. Would I trade TSM? Absolutely. Lots of days I trade TSM, but would I go and put a long-term investment on Taiwan Semiconductor because it's really beat up? I mean, it's an attractive price, but that risk is just so great. Like if that happened, the stock could get cut in half just like that.
And overnight.
So, I mean, you can say 140 to 64. Well, this stock, just has, it's just gotten too cheap. I'm going to buy it here from fundamental basis. It's probably true, but you got to take that risk off the table. You got to take that risk of an invasion completely off the table for me to get in and go invest in TSM too. And that's all market investing and trading is risk management. I can't manage the risk on that. So why in the hell would I buy it?
That's the trouble.
What did I thought I saw this morning. Headline. I like one person is not too worried about having their money invested in China. Is one guy that is definitely smarter than me and definitely a better investor. Warren. There was some news about a Chinese EV company that he's invested in.
Yeah.
And it just did you get the news on that? That's
BYD.
It's like putting Tesla in the rearview mirror.
Yeah, that's BYD, and that's the Chinese electric car maker. And so they've been doing pretty well. Their net profits in 3 months up between
Not
333%. Yeah. Well, not the. I think that's might not be the exact ticker. That's the company's car. I mean, the
that's
ticker.
Ford Gaming. Ford,
it trades in China. It doesn't trade. It doesn't trade here.
Yeah, it's not trading here. That's what I'm talking about.
It's like 1211 HK. So if you wanted to look it up, but yeah, so that's their Chinese electric vehicle.
Warren's not worried about it. So,
I mean, Warren's not worrying about a lot of things. Let's just be honest.
He's getting older. Warren,
he's rich. He doesn't have to worry about anything. What's the worst
he's
thing
still
that can
trading
happen?
like he's still trying to make everybody money. We got to love Warren.
Exactly. I mean, he's an Apple. He's an Apple lover. Let's go. What is it? 8:33. We could sneak one more in here before we get towards our guest. Let's cover Silvergate. And this was interesting because Wells Fargo had put a sell rating on them. Silvergate Capital Q3 EPS at $1.28, missing the $1.34 estimate. Sales at 89.34 million, missing the 100.35 million estimate. And it's tough. SI Silvergate.
I think this is a kind of stock to buy the pullback on because it's risk, but it's not the kind of stock that I'm going to buy. Just because this is just, crypto and everything else that they're doing in there. It's not my cup of tea. But I will say this kind of stock is the kind of stock that they do, come and buy the dip on. Is that all there was just earnings? Was there anything else? Like it's just getting so heavily offered that made me think that did they do an offering? They didn't do anything like that, eh?
No, they didn't.
I'm just trying to look.
6170 was this low here. You got a shot at it in the pre-market, $3 above it now. Don't know if you're going to get another shot at it. I'd keep an eye on 6170. In order to fill the gap, you got to get up to 6923. Were they big into crypto or something?
Yeah, they are.
Silvergate?
Yes.
Yeah.
They have a big investment in crypto.
I have it classified when I'm trading with the crypto stocks.
So, okay.
I don't know. Maybe they do some other stuff too, but I've got it as a crypto stock.
Majority is crypto for them.
I just don't like crypto, so that's why I'm probably not investing in this one or buying the pullback. But
I mean, it's like MSTR, right?
This market's FOMO. You got a stock trading back down near its lows from Thursday. Money managers are going to be looking at that, and it's not surprising, Joel, where it bounced as well. When you were looking back, the 61, the low of the move on Thursday was 61.70. It bounced right in the 61 handle. That's not surprising here either. I wouldn't want to be shorting it down here. I'll say that much.
All right, let's get towards our guest today. Let's get out of SI and Silvergate Capital, and let's go to Nate Tobik here, investor and founder of Complete Bank Data. How we doing today?
Good. Good morning. How is everyone?
Oh, you lost Dennis right quick there. It looks like it's toast time, but that means we got Nate time. Yeah, so too much gold for him.
I'm always listening. I just blipped, internet just blipped there.
Oh, that's not good.
I'm here, Nate.
All right,
Nate,
good.
We had you on a couple months ago or a month or so ago, and I put you on specifically for this date because the bank earnings came out and everything. Last time you're on, why don't you pound the table and say it's good for banks in a rising interest rate environment? We don't know about a recession, but the interest income for these banks is going to be a lot higher. And to get loan to banks.
It is while their deposit costs don't rise.
Okay.
Right. That's the biggest thing. So yeah, I mean, earnings were great. Like Bank of America, let me look at the number. I think their deposit cost went from 8 basis points to 35 basis points. So
explain that. What deposit costs? Because I know they're shutting down all the drive-through windows.
Well, yeah. So here's kind of what's happening right now. This is actually happening in the market, and it's not really in the financial releases, but it's anecdotal. Is everyone sitting at a bank? This is myself included. I think my bank is paying me 0%, and if I open a savings account, I get 0.1%. Okay, I could go to a money market account. If you go to edwardjones.com, they have brokered CDs. Fidelity.com has brokered CDs. You get a 6-month CD. You actually get a 3-month CD at 2.75%. You get a 6-month CD at 3.85%. You get a year CD at 4%. So you say, okay, wait, why is my money sitting in a checking account? You go to Treasury Direct and you could get the treasury, you know, whatever you get out of treasury bond. And it's like, why is my money sitting there earning nothing? And so people are pulling deposits, putting them into CDs, or they're putting them into money market funds. And what's happening is now banks have to start to be competitive on their deposits. So instead of offering nothing, it's now 0.5%, 1%. It's too little, too late. That's the problem. But so they were able to get away with not raising those deposit costs for a long time, while the interest cost on, or the interest on the loans kept rising. And that's why we had significant earnings from a lot of these banks. Now what's going to happen is those deposit costs are going to be trending up at the same time that, you know, they're going to come more in line with historical norms. And we're going to see more net interest margin compression, really. But the ones who did really well against it were, like, if you looked at Bank of America, their earnings, they did just fine on interest expense, interest income, and they really blew it out of the water with trading bonds. So kind of the choppy bond market, they did well with that. Goldman Sachs, they did well with trading. So you look at the big ones. Goldman Sachs, they did not do well with investment banking. Morgan Stanley, their investment banking didn't do well. All the mergers and acquisitions, that stuff's down. But if a bank has the ability to maneuver and to trade in this market, they're making up that difference.
You think it's a one-off then for these earnings, with they caught that window. Now they're going to be forced to give people their money at better rates, and this is just a one-off.
I think the market is going to segment significantly. So what you're going to have big banks and regional banks that will do okay. Small banks, they you're talking about Warren Buffett earlier. What's that, like, swim? You find out who's swimming naked or something when the tide goes out. Well, the tide's out, and there's a lot of people standing in the water naked, looking around, thinking, "Is it just me?" And that's the reality. So for a lot of these small banks, they had so much excess cash. Even bigger banks like First Republic Bank, they had so much excess cash. They bought a ton of securities. Those things have all been marked down as rates have gone up. So they have the inability to sell them. So they can't really fund their growth through their securities. So then if you go to fidelity.com and you go to their CD marketplace, you could see the list of banks who, they need funds and they need them today. And they're willing to sell it at 4% plus to get that. First Republic's in there. I would almost say that there's a Town Bank was another one I remember seeing. I'd have to go back and look. I went looking through that yesterday, and I was like, these are probably all avoid banks. If someone's out there trying to broker CDs, you probably don't want to own that one.
So I don't know if you caught recently yesterday, none other than Jim Cramer recommending Wells Fargo or Wells Fargo, whichever one you want to call it. What do you think about that, Nate?
So I'm not a Wells Fargo fan. I think the culture is just the culture is rotten and nothing's changed and things keep happening over and over. And it's like, oh, this is a one-off. Oh, wait, maybe it wasn't a one-off. Maybe it's another one-off. I'm not a Wells Fargo fan, but the thing is, so any of the big banks, where they have a huge benefit is they're getting larger deposit accounts from businesses. They're also structuring their loans. So they're doing a lot of larger business loans. So it's a floating rate loan. So what they're able to do is, as rates go up, those loan rates are going up as well. And just because they have products and services that other banks can't offer, a lot of those customers are captive to them. So they will end up paying more for deposits, but they don't have to pay as much. And so as long as the largest banks don't do something stupid like the subprime type stuff, I think those are actually the place to hang out through all of this.
So I think you would be a fan of the inverse Jim Cramer ETF, but we won't get into that. Let's talk a little bit about SoFi. What do you think about that retail favorite?
You know, I'm not a fan of SoFi. I'm not a fan of really any of these. So there was SoFi and oh man, there's another one they just got a bank charter and they'd been eating through capital. I think fundamentally what's going to happen here probably within the next year is a lot of these. So, you know, there's a couple ways to become like disrupt banking, so to speak. And really the best way to disrupt banking is by offering better customer service and better products and not offering products to segments that they feel are missed out. A lot of these companies, including SoFi, it's, hey, we want to offer products to segments that, you know, we don't feel like they were getting a really a fair shake before. I think what they're going to realize is that a lot of those accounts are not really valuable accounts, and there's going to be a lot of problems hiding in there. And so, you know, so it's essentially like the buy now, pay later. If someone isn't able to, if they can't pay for something and you're offering some sort of a crazy layaway plan, and everything is going well, that's okay. But when things start to fall apart, that is not a good credit. And there's a reason that banks don't do that. So if you think about the market, here's a really interesting way to think about the whole financial market is at the top, you have the major banks, so Bank of America, Wells Fargo, JP Morgan, Citibank. Okay, below that you have, so this is in terms of credit quality, in terms of the ability to do big loans. Below that you have regional banks, and that's the you know, the PNCs of the world. And then below that you have all these community banks, all these small banks. Now, a lot of people think it stops there. It actually doesn't. It then takes a step down and you have all of the credit unions below these community banks. And then once you drop below the credit unions, now you're into stuff. It's like the buy now, pay later. Hey, you know, where could I get this easy credit type stuff? So like if you look at SoFi, they have a lot of credit card interchange income because there's no interest income because none of their customers have any money in their bank accounts. So they have people who, you know, it's like, hey, I've got $600 in the bank account and I am cycling through that $600 every single month and there's nothing left at the end of it. And it's hard to build a business on that. There's businesses that do, but that's a tough pull.
We're on the line with Nate Tobik. He's an investor and founder of CompleteBankData.com, author of the Bank Investor's Handbook. Nate, just want to talk to you. Do you think if some of these big banks had a lot of exposure to Russia or what's going on in Europe, do you think they would, you know, let the cat out of the bag this quarter, or do you think that's something, you know, some big write-offs are looming because of the European situation? And then give us your favorite European bank to invest in.
Oh man, my favorite European bank is don't invest in European banks. That's it.
Number one rule.
There's actually, I do have one. But so yes, the in terms of write downs looming, there are things bubbling under the surface. So last quarter, Bank of America, they released $1 billion. I think it was $1.1 billion of reserves. They said, hey, we don't need this for bad loans. And then this quarter, they set aside an extra $870 million, I think, for potential bad credits. So at the end of last quarter, they thought, hey, smooth sailing, we don't need this money. Suddenly this quarter they do. They didn't identify what those assets are. Is that European assets? Is that something else? We don't know. I would say if you're thinking about banks that have European exposure, it's going to be JP Morgan and it's going to be Citibank. It's probably not going to be Bank of America or Wells Fargo as much. So I would think of, you know, if there's exposure or potential write down, it's going to be in those two. In terms of a decent European bank, I like the Credit Agricole regional banks, and there's 12 traded regional banks. They're all in France. They They have tickers like, let's see, like CRSU. One of them, its ticker is crap. That's an easy one to remember. They all pay like 5-6% dividends. They are all kind of closely held smaller banks, all owned by Credit Agricole. Like part of them owns the parent bank. The parent bank owns part of them. And every once in a while, some of these go private or they sell out, and there's a heyday, and you kind of get the, it goes from $100 a share to $250, $300 a share. But these are a decent place to camp out if you really want European exposure. There's also some really interesting little European, like some French small caps where they're exposed. They're in Europe, and so they trade in Europe, but they actually have worldwide exposure. And so these banks are dealing with those industrial customers. But yeah, I would not be like Deutsche Bank, Credit Suisse, all that. I would not touch those things. I wouldn't touch British banks either right now. It's not. Something is unsettled there, and we're not exactly sure what. And I think by the time it falls out, this is like, people were like, "Oh yeah, Bear Stearns is such a great buy at $50 or $60 a share," and then a couple months later, you're like, "Oh wait, that was not a good buy." Something was lurking, and we weren't quite sure what. And so when there's ambiguity like that or uncertainty, and it's uncertainty to the level where you say, I could see their capital destroyed. You don't want to be in a levered institution with that sort of a scenario.
Nate, all these European banks look like they're in their own financial crisis. The charts just look like this. I mean, Credit Suisse, $20, $30. 8 years ago, it's $4.
Yeah.
I mean, they all look like they're actually, in trouble. I mean, the charts look like they're in trouble. They're all $5, $6. I mean, what was the high in Deutsche Bank, Joel? It's $8. Wasn't it like 150? I mean, these things are all pricing like there is a financial crisis. So one of two things. I mean, they're either really good buys or they are in a financial crisis, and a lot of these can end up, being in major trouble.
Yes. I mean, here's the thing with a bank is, so say that there is a financial crisis and Deutsche Bank does survive. So what's typically going to happen is there's going to be that crisis period. That's probably going to be the low in the stock. And then that thing might bounce. Maybe it gets to 15. But once it's at 15, that's now it's going to be rebuilding its earnings. And that's still a good buy. So yes, people get lucky buying right at the bottom with some of these banks that they just barely made it. And it's true luck. The better thing is to know, hey, this bank has made it through. It's still trading at a depressed valuation. I mean, if it's at $50, or $15, we're still talking down 90%. So it's a better buy at down 90 than it is down 95 or whatever it is here, because you just don't know. Right now, it still could fall another 50%. We're not in the there's a resolution to this type of a thing, or even a clear path.
I got one more for you here coming out of the chat, and boy, I haven't heard this term in a long time. Overnight repos, and we got a question here from DAZYV. Asked Nate about the overnight repos, which was down last night. He saw in a post on Twitter. Says is an indication of 200-day support. Talk about the overnight repos and the implications for the market.
Right. So the overnight repo is assets that hedge funds or counterparties cannot get credit from a major investment bank. So the Fed's sort of supporting this market. A lot of people think it's kind of, it's garbage marks, and they're just trying to wait out. I kind of think of the overnight repo as, say you bought your house for $500,000, and now everything in the neighborhood's going for $380,000, and you're like, well, I had someone who was interested in $500,000, and I'm just going to keep trading on that until things recover. And it might work. You might be able to beat it out and then to offload some of those assets, or you might actually have to recognize that loss at some point. So yeah, as that thing balloons, that's essentially I mean, so Goldman Sachs has turned down those funds saying, yeah, we would provide a overnight financing for these assets at the value that you want. But the Fed says, no, that's fine, we'll take it.
So great.
So it's not great, but the thing is, this is one of those, it's been rolling forward and getting bigger and bigger for a couple of years now. And when you think about like what it means and what the overnight repo is, it's like, wow, this looks like the bottom's about to fall out, yet it hasn't. And so I don't know what to like. Maybe they just keep floating this thing forward and it resolves. I'm actually not sure, but it's not a good thing.
All right. Yeah, so was that a Miami Redskin glass there, or was that a?
Oh yeah, yep, that's right.
You're a Redskin. Okay, Mitch, did you have another question for him?
No, I just wanted to say the only repos I know are the ones where you hear, the tow truck in the back and you're running out the house. But I just wanted to wrap up there. I appreciate you joining us today. Like always, Nate, it's good to have you. And I will be watching to see what happens to those buy now, pay later situations. I'm sure it's going to have an interesting end to that story. We'll definitely have you back on to speak all about it. You guys go ahead and check out CompleteBankData.com if you guys want to learn more where Nate works, and appreciate you, Nate. Have a great one.
Thanks for having me on. Have a great day.
Take care.
Thanks.
All right, let's wrap on up. How's the markets, Joe?
It's just rolling, man. I said I didn't think it'd get to 38.20 today. I don't know, man. This has been.
Let's see the SPY. I don't want to see Deutsche Bank. Let's see the SPY.
Okay.
Yeah, no one wants to see Deutsche Bank.
Let's see how the SPY lines up a little bit differently, where 38.20 was my number, but right here, I mean, you got to think that the bulls, or maybe not today. Where are we at? 375. Why not? Three highs in the same area. 378, 379. Let's call it 379 for the S&Ps. I don't know, maybe because of the usually they correlate a little bit better, but the S&Ps, the key area that I'm talking about, that two-week high is 38.20. We're 50 handles away. Oh boy, that
go back to that SPY chart. Why the heck was the SPY chart so messed up? Or maybe it just the top left I'm looking at for the pre-market.
No, top right. I don't know. 379 is not lining up with the usually it would be like this would be like at 380. Right.
Why is your SPY pre-market chart not showing the pre-market?
Oh, because whenever I go to futures, I've never been able to figure out.
There you go. That's what I'm looking at. I was like, this is
there
not the SPY chart.
Dennis and I were like, that's not.
I'm like, we've been climbing relentlessly for the last hour here, and it's not showing it there.
I wish I could be that chart, because then we would already know what's going to happen.
Yeah, bye. But there you go. I mean, just climbing, and you can see on the dailies here with the SPY, you do have a little gap fill. Where's the gap fill at? I know with the SPOOs, it was what's this low right here? No, 372.68. See you later on that. So 379 and 38.20 in the SPOOs, or maybe not today, but maybe later in the week, and that's your 2-week high. But everything's ripping. I mean, can you find anything down? Anything with bad news on it?
Nothing.
Well, there's one area that we're definitely going to be watching after the bell, and of course, you guys can catch the earnings call right here on Benzinga. You don't got to go anywhere. Netflix earnings call today after the bell. Netflix had a great run yesterday.
Yeah, it did.
Big move. Was looking for a move up. I didn't expect it to get all the way to where it got to yesterday. Definitely a big run on Netflix.
The 250 area right there. Yeah. Go ahead.
It's trying to break out. I mean, we're going to see. The earnings are going to be obviously a coin flip event, but right now, if it pulls back on a significant pullback, there'll probably be, people looking to buy the dips. So again, such a tough market to be bearish in right now when they just can't stop buying it.
We'll see.
I'm waiting for the eventual rug pull.
The big thing with
I
Netflix,
feel like something's going to pull the rug here, and then we're going to get an opportunity to buy some stock. So I'm frustrated with just the relentlessness, because obviously I'm sitting with 42% cash. I'm hoping we're going to get some type of event where it knocks the market back down, and that's going to get us a chance to get some more exposure here, because there's a non-zero chance that the low was made 3 days ago. There's a non-zero. Not saying it is, it is the low, but I'm saying it's possible it was. So got to respect that. Got to respect the change in sentiment here in the last 3 days.
Netflix is expecting to snag 1 million subscriber ads this quarter, right? Of course, pay attention. What if they lose subscribers again? Well, Netflix would get hit hard. So we'll definitely keep watch to see what happens after the bell. No one knows where the subscribers will go, but of course,
it, $7
Netflix,
or $10 or $11? How much is Netflix?
Oh, well, now they have the ad tier, right? $7. It was about 14, $15 before. So we'll see. I mean, they were losing subscribers for 2 quarters. Now they're expected to add another 1 million subscribers. Let's see if they actually got those subscribers back.
All right, 2 minutes here. You can tell I'm distracted just because there's just so many positions here I have on right now, and I'm like trying to do a live show. I considered not doing the show today because there was so much action here, but we'll let you guys finish up.
Yeah, go ahead, Triple D. Anytime. We definitely got a lot to talk about. Should we? What do we got?
Salesforce.
2 minutes.
Salesforce. Let's talk about Salesforce. They did get an activist investor revealing Starboard revealing a stake in Salesforce.
Starboard getting down.
So that hit in the middle of our show there. Hit the tape. We'll have to see what happens here in Salesforce. I mean, this is one of the best companies, right? I feel like everyone believes in Salesforce. I think Starboard is taking their shot now as it's come down on a discount.
Well, if we go to the Starboard move from yesterday, that was it PayPal? Who did they get down and dirty with yesterday? Was it PayPal that popped to 78? No, it wasn't PayPal. Starboard did something yesterday, and Splunk. So if you're using the Splunk playbook, it hit the pre-market high and faded considerably off that, right? Pre-market high, boom. Now you get back up to that area. So you did get the initial pop here in CRM. I did notice that 160 area was kind of pesky. You backed off $4 from that. 160 here, just over 160. So now that you pull back $4 off it, I think it's going to be a little bit harder to get up there. I'd find an intermediate point. Maybe you'd be looking at 58.25. That's the next daily high I can see. That's still $2 away. See if you can get lifted at 58.25. Boom, coming back on. It's just one of those days, if the market stays strong, you're not going to see the top of the range from yesterday. That's 149 even. So I think longer term, if it comes back into one, everyone kind of forgets about it in a couple days. You have a couple bad days in the market and maybe get it back down to this 149, 150 area. But looks like it was a sell the pop there. So, all right, I'm going to wrap things up here today. This is it for me for the week. No at the close today, and then I'll be gone for the next few days. So everyone behave, be nice to Dennis and Mitch, and I'll be back with you guys on Monday. Go get them.
Have a good one, Joel. Like always, you guys can keep up with Joel on PreMarket Prep Plus, and he will be out for the rest of the week. So you have a great time off, Joel. We'll try to do our best to keep up with all the market action right here, of course, on Benzinga. Up next, you guys got some live trading action. If you guys want to come over and trade with us, check out Zunaid, Lord Ryan, and myself as we get into the action. We'll see what happens today. Will the SPY break through that 380, or will we have an inside day? Maybe could possibly happen, or will we get a red day? Don't expect to see that. But of course, you never know what can happen in the markets. Like we always say, is no one knows. The only thing we can do is try to set probability in our favor. We'll see you next time right here on PreMarket Prep. And let's keep going and start the day. It's time to shine and go trade. I'll see you, traders. Up next, live trading.